Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, August 9th, just after the close. Indexes masked a little bit of volatility this week. S&P 500 only off 0.1%. NASDAQ off 0.5%. Let's call it Dow down 0.75%. But plenty of intra-week volatility. Last weekend, ramping into Monday, you got China talking about currencies, whether they would off-play Trump's additional 10% through their currency market. That gets people nervous. That gets all the way back to 97, Thai baht, which led to quite a pullback in the S&P 500, led to weakness in Asia, weakness in the energy market, into 98, the Russian ruble, where they end up defaulting on debt. That's always in the mind of longer-term traders when they hear currency wars or currency headaches. Sometimes there's an overreaction to that. Every 18 months, seems like there's another currency headache. But that's where some of that stems, just to try to give some thoughts of what we talk about here. What changes or modifications did we make in the strategies this week? US ETF, no trades, 20% cash. That's a level we're comfortable with right now. International, one change. Took some money out of Asia, the emerging markets, moved that into Switzerland. It's a 5% buy in Switzerland. Switzerland's been King Kong of Europe, not only Europe, but of the international markets. Tactical, moved money out of emerging markets into Microsoft. Microsoft again, trading very strong, good relative strength. We took that up to an 8% position in tactical. What do we like? What are we nervous about in the markets? Always have to look both ways. Context is important. If you're always concentrating on what can go right and what you like, you're setting yourself up for a nasty downdraft. The opposite's also true. If you're focused on negative, you're going to miss some things happening in the market that have positives attached to them real quickly. The negatives are obvious. We don't like the reaction in the international markets to the trade war talk, both ways. US markets holding up fairly well. International markets trading poorly. Some of them starting to threaten that good move they had through December and January. Important for us to keep an eye on that. Domestically, headline risk continues to be a headache. Trade risk continues to be a headache. But what do we like? Very impressive that even through Monday, the broad indexes made higher lows than they did just in May. Remember, we had a little nasty pullback in May. Well, we're 2, 3, 4% above those lows, even with Monday's news. We saw the 10-year last Friday trade down to 175, or close at 175. By the way, on Monday, traded as low as 160. We're back up to that 173, 174 area today. Well, what the topic was last week in the video is the fact that it had traded down through the dividend yield of the S&P 500, which we'll call 190, 1.9 for this exercise. It just so happened that the folks at Dorsey Wright and Associates, who are a tremendous database and analytical firm focused on relative strength, trend, supply and demand, and multi-asset classes. I've been a customer of theirs for almost 25 years, believe it or not. Just so happens that today did a study in their daily report, taking a look at what the results have been each time the S&P 500 dividend yield was north of the 10-year Treasury yield. It went all the way back to 1962, and we're going to have it on the video for you to look at while we're discussing this. Back in 62, the 10-year yield and the S&P 500 touched each other. They didn't cross, but they touched. Since then, and we're talking now about, 65 years? It's happened 8 times. First time back in 2008, which makes sense with quantitative easing. The performance of the S&P is interesting. Has been net positive each time on a 3, 6, 9, call it 12-month period. That's not an easy walk in the park each time, There's been drawdowns, there's been negatives. There was a drawdown of as much as 17% back in '08, which if people were investing and trading along with us in '08, they remember half those days we were jumping out of our chairs. But in terms of performance, fairly steady. Talked about last week. Does the fact that you can pick up 1.9 in dividend yield from the S&P 500 cause an investment advisor or a trader or an investor to reallocate or at least think about pushing more money from fixed income over to equity? I don't know the answer. Everybody's situation is different, but it's at least something that gets talked about from the smallest investor to the largest institutions. We'll see how that plays out over the next 3-6 months. But I thought it was a coincidence and very interesting that Dorsey Wright put this chart up today. It lends credence that we have to take interest rate movement in context. Context in the markets is very important. Too often we get hit with statistics that by themselves don't mean anything, but are said and issued as if they have a lot of weight in the market. For example, the inversion of the 10-year and the 2-year. We hear this almost daily now. As a matter of fact, there's tracking graphs on how far away, 8, 10, 12 basis points from the 10-year running down through the 2-year yield, and that creating situations that in the past historically have led to recessions 6, 12, 18 months down the road. Again, important, but tell us at the same time where that was in interest rate cycles, not by itself, because I also want to look at things that can go right. And that's what we're trying to have a discussion on here in our trading room, our research room. What can go right? What can go wrong? How do we get positioned for that? Right now, we've been, not to sound repetitive, but we're still caught in that 2750 to 3000, 3025 S&P range. Wide range, but it appears that there's plenty of demand when we trade to the bottom of that range. Let's see what next week brings. Some of these asset classes are getting attractive. We'll take a look if we can move any of that cash, as I mentioned, 20% across our strategies into some securities at an attractive price. Have a great weekend. We'll see you next week.